Once again, the financial news is gripped by the topic of the US debt ceiling, and as always, it has got the potential to disrupt the markets for as long as the issue drags on. So let's go through what this is all about. The debt ceiling is a limit on the US national debt. It basically caps the total amount of money the US government can borrow, and it was introduced so that Congress could keep the government fiscally responsible. But since the US government spends more money than it receives, its national debt is continually increasing, and after a certain amount of time, it reaches the debt ceiling. At this point, a solution needs to be found, which usually involves Congress coming to some sort of an agreement to increase the debt ceiling so the government can continue to borrow more money. Now, if the debt ceiling isn't lifted, this could result in the US government being unable to pay their bills, such as government employees, welfare payments, and even servicing their debt. Not being able to pay debt could be catastrophic, not only for the US, but globally as well. For a start, the reason the US government is able to borrow money at such low rates is due to the safety that treasuries offer investors. The yields on treasuries also affect other rates throughout the economy, so not only would the government have higher borrowing costs themselves, but so would the rest of the economy. Now, the US wouldn't be the first country to default on its debt, but it would be one of the most damaging. In fact, as the government has got alternatives to avoid defaulting, it would mean they're choosing to do so, and this would actually go against the Constitution. This and other factors would damage America's economic reputation. Other countries that have defaulted in the past haven't had what is considered to be the world's safest asset, treasuries, and a currency that is the global reserve. So what this means is that there isn't really a comparable situation, and the consequences to the US and the global economy could be much more extreme than in other cases. Well, raising the debt ceiling is actually pretty common, and it's usually done in a bipartisan way. However, this isn't the first time that the US has come close to hitting that ceiling. There's a couple of notable times in recent years, such as in 2011 and 2013, when it was amplified by the dreaded fiscal cliff situation. In 2011, Republicans used the debt ceiling as leverage to try and reduce the deficit, and again in 2013 to try and force Obama to defund the Affordable Care Act. Well, this time, Republicans opposed the big spending bill which is being passed through the reconciliation process. They'd prefer Democrats to provide all the votes for raising the debt ceiling and for it to be part of the reconciliation bill, but Nancy Pelosi previously said that she wanted to raise it in a bipartisan way, and now it may be actually too late to go through with that lengthy process. So as a result, the majority of Republicans are refusing to lift the debt ceiling. However, Democrats also argue that debt increases have come as a result of previous administrations, such as Trump with his tax cuts, so it needs to be raised anyway. So Congress has now hit this block, which is why there are fears that there may be a default. But, a default is still an unlikely outcome, and this sort of brinkmanship is a common occurrence in these sort of situations. With time running out, politicians can use that as leverage to get deals done that they want to happen. As the famous Winston Churchill saying goes, never let a good crisis go to waste. So let's say that Congress fails to raise the debt ceiling in time. What options are available to them? Well, option one is short-term extensions. If the US Treasury comes close to running out of money, Congress will probably agree to some sort of short-term extensions to avoid the default and extend negotiating time. This may not just be limited to one extension either. There could be multiple of them that last for over a year, similar to what happened back in 2013. However, if an extension is left to the last minute, then we may start to see some panic setting in the markets. For example, this may result in a sell-off of treasuries, which would push yields up and therefore increase borrowing costs. This would be similar to what actually happened in 2011 and 2013. But as long as the debt ceiling is raised before funding runs out, then things will sort of return back to normal pretty quickly, as was the case in those previous situations. Option two is prioritizing obligations. So this would be like in 2011. The FOMC discussed this as being a contingency. And in this scenario, none of the treasuries would be defaulted on. Instead, the treasury would pay interest on them as they came due and issue new securities of the same value as they matured. Now, this approach would avoid defaulting on current debt and would not add to public debt. But in order to take this approach, the treasury would need to hold back on some payments for other obligations, such as for social benefits, to make sure that they could pay their debt first. Now, the Treasury Secretary, Janet Yellen, was also part of those discussions since she was back in the Federal Reserve back then, so we can probably assume that this contingency will be in place once again. Now, it's difficult to say how the markets would react to this situation and how the Federal Reserve may react to stabilise the markets. But if investors remain confident that they will continue to receive interest payments, it may not actually end up being as bad as it may seem. The problem is that it could cause longer-term irreparable damage, such as a shock to consumer confidence, particularly if it lasts for some time and people begin to feel the effects of cutbacks. If it comes to it, there are other more extreme options available as well, such as scrapping the debt ceiling altogether. This is something that many economists and politicians have been calling for some time. It seems like the obvious option to make at some point, but again, it's this political theatre. Monetizing gold could be an option, and there's even been a lot of discussion about minting a high-value coin that would then be deposited at the Federal Reserve and used to buy debt. It sounds crazy, but it actually makes a lot of sense to do that. But overall, an actual default seems very unlikely, at least until all other options have been exhausted. This is just another case of political theatre and brinkmanship. So things are likely to get resolved without any severe consequences. But as always, we do have to prepare for the unexpected. I think the past couple of years have taught us that well enough. So let me know in the comment section what you think about this topic, and let me know if there are any other current topics that you don't quite understand that you'd like an explainer video on, like this one, and I'll see you in the next video. Thanks for watching.